Good evening, everyone. Welcome to the special call on the launch of Mira Asset Multi-Asset Allocation Fund, Nfo, which is begun from today and which is live till 24th of January. Today, we are going to explore about the world of multi-asset. We'll try to understand that why this product category suddenly is becoming so important from an investable universe, as well as what are the features of such a product and what does Mira Asset brings to you in this multi-asset NFO. Joining me today is Mr. Harshad Burauke. He is the head of research for Mira Asset and also manages this product on the equity portion. He also spearheads our hybrid strategies across all the various hybrid funds that we have: equity savings, balance advantage fund, aggressive hybrid funds, and then finally we have this product which we are introducing to our investors today. Mr. Harshad, a brief introduction about him. Harshad joined Mira Asset Mutual Fund in 2016, and he's overall looking at research and investment processes at Mira Asset, and his core coverage sectors include financials, oil and gas, and economy. He has more than 18 years of experience, professional experience across various industries, and prior to joining Mira Asset, he was also taking care of research at Motilal Oswal Securities. Harshad, by his academia, is an engineer and also has done MBA in finance. Today, as we delve into the multi-asset framework, I would welcome Harshad Burauke to this special call. And Harshad, what's in store for multi-asset from Mira Asset is something which everybody would like to hear from you today.
Sure. Yeah, thanks, Denny. Thanks for the opportunity to come and interact with our investors. Thank you.
So Harshad, let us begin by looking at the product. I think the first few slides are going to talk about where does people's savings reside, and maybe we'd pick your brains on that how does a multi-asset play to the actual wallet share of Indian investor in its true sense. So if you look at this slide, if we can go back one slide, maybe that's where the real context of the presentation begins with. As per the RBI data, if you look at the overall Indian household assets, it's about 11.1 trillion of assets which are there, which is predominantly occupied by property, gold, bank deposits, and then the other instruments, and then coming to equities and cash. You also look at, if you just remove properties, and if you look at the percentage of household assets minus properties, then we are looking at gold, we are looking at bank deposit, we are looking at insurance, we are looking at equities. So this is where actually the Indian investors invest, right? And multi-asset is a product. As we go ahead, we'll talk about it, that how does it appeal to this sort of investor base. Moving to the next one, I think this is one slide which has become very popular of late. It talks about how each category among gold, large cap, small cap, mid cap, international equities, corporate bond, credit risk, real estate, GSEC, and then T-bill across 2010 to 2023, each year how it has performed. And I think it is a clear thing that no one can predict who's going to be the winner among this. And it's always a mix. If you actually mix this and you invest across the mix, you will settle for a much more stable return rather than trying to guess which will be the best return, right? And if you look at all these segments, the next slide we are talking about how are we clubbing them, right? And how multi-asset offers a chance to look across. So your large cap, mid cap, small cap is nothing but represented by equities. Your gold is nothing but represented by commodities. International equities fall under the foreign equities purview, which is also part of the product's asset allocation framework. and then corporate bond, credit risk, T-bill, GSEC, all of that combined to become debt. Of course, we will not be going to a lot of these segments. We will prefer to be more liquid segments and more, quality segments in debt. And finally, we have REITs, which is maybe a good representation for real estate. So when you saw the previous two slides, it talked about where the Indian investor is investing and how across different time periods, what has performed best. And all of that clubbed together becomes a multi-asset strategy, right? So moving to the next one, I think this is where what we have done on this slide, and I would then ask also Harshad to sort of share a little bit more of his views on this. We have from 2009 to 2023, we looked at how equities performed, um, and this data is from now 2009 to 2023, right? So how equities performed, how gold has performed, how debt has performed, and how multi-asset has performed with that framework of 65 equity, 20 debt and gold and all of that framework, right? Now, what is very interesting to see, as you can see, is that multi-asset is represented by a white, sort of the white color here, right? It's not present in the top line. It's not present in the bottom line. It's in the middle, which seems to be more consistent. And I think that's before I hand it over to Harshad to talk more about what he feels about the product, how equity performs, how debt performs in various market cycles. Probably one of the key takeaway of this presentation is that if you look at multi-asset, it's a product to optimize return, not maximize return. So if you're looking at products which could deliver a return more consistent, then maybe this is the correct category for you. So from here on, I would request Harshad to now talk more about what each segment brings into this framework, how Mirasit looks at this equity framework here, and overall what the product will deliver to the investor. Harshad, over to you.
Yeah, thank you, Srinivas. Thanks for the introduction. And as you rightly said, multi-asset tries to optimize the returns for the investor. So our take, on the category of multi-asset per se. So we believe multi-asset tries to, essentially achieve three things. One, it reduces volatility in the investor's portfolio. Secondly, I think the experience from the returns point of view is also satisfactory. And thirdly, more so in the extreme market conditions, when markets were to go down significantly, multi-asset category will fall less. At the same time, when markets were to move up meaningfully, I think this category will also have a decent participation. So let's delve into these three key factors before coming to our fund strategy. So as you can see on the chart on the left hand side, the orange. So these are the 15-year daily volatility for each asset class. Now, one is equity, second is gold, and third is debt. Equity, as you know, while returns are higher, but at the same time, volatility is also higher. On the other hand, debt, where returns are lower, but again, volatility is much lesser. Gold lies, somewhere in between. So here, I think if you were to combine these three asset classes, which is what multi-asset fund will try to do, or the category will try to do. So we have tried to combine it in the proportion of equity at 65%, debt at 20%, and gold at 15%. So here the key output of this exercise is if you look at the standard deviation, which is a measure of volatility. For equity, it is 1.3%. It comes down in this combination of assets 0.8%. So I think clearly, the reduction of volatility is what this category tries to achieve. Secondly, if in terms of return experience, so what we have done again, so last 15 years on a 3-year rolling return basis, tried to look at what are the returns in each asset category. So first, let's say equity. So the return potential, return range, as you can see, is negative to as high as 34 to 36%. So equity, in the last 15 years, 33% of the time, equity has given returns somewhere between 10% and 16%. On the other hand, if you were to look at gold, so around 17% of the time, the gold returns were negative. Debt, on the other hand, I would say very tight between 4 to 8%. So 90% of the time, the debt returns were between 4% and 8%. So again, similar to what we did in the volatility, here if we try to combine these three asset classes, so I would say experience is quite decent over the period. So around 70%, 75% of the time, you would get returns in between 10 to 16%. So what essentially it does for investor, one, it helps you avoid this, negative zone which was seen in the gold. And also at the same time, if you look at the equity, there is also quite a few data points, which on the negative side. So from the experience point of view, I would say, adding three asset classes is a much better experience. Thirdly, I think again, if you were to look at different market scenarios, so let's say markets fall down significantly, or markets move up significantly. So let's go back to the global financial crisis time period from April 08 to November 09. So markets at that point in time in that period were down 18%. Combination of these assets was down only 8%. So clearly, there was a decent downside protection. Now let's go to the bull market, when markets are doing really well. So a period, let's say between September 20 to November 23, when the markets moved up by around 22%, the combination of these assets was up by around 17%. So clearly, even in the market upcycle, I would say there was a decent participation by combining these three asset classes. Now, one analysis I think people like to do or try to do, is let's look at the drawdown. So typically, how much time it takes for my fund or my NAV to come back to its original value in case it moves down. So in the bear market, same time period, if you look at equity, it took almost 221 days. Gold, on the other hand, when the markets were sideways, again, took some 670 days to come back to the original value. Again, gold in the bull market took around 341 days. While these are extreme scenarios, but again, if you have to combine these three asset classes, I think experience is much better, vis-a-vis any other individual asset class, in that time period.
Harshad, here just on the slide, maybe there may be a lot of investors who don't know what a drawdown is and how does it work and what is its significance during different markets. If you could just maybe explain in 30 seconds what does drawdown mean to them.
So drawdown is nothing but, let's say you start your investment with 100 rupees, and at some point in time, due to various factors, if that 100 rupees for some fact, goes down, let's say at 80 rupees or 60 rupees. So how much time, it takes for that initial investment to come back to the 100 rupees from either, 80 rupees or 60 rupees. That's what generally we mean by drawdown analysis. So this is what we have tried to do, for different asset classes. So as I said, the gold surprisingly took 670 days to recover when the markets were largely sideways. So these are extreme scenarios. I think this is what multi-asset as a category tries to avoid. Srini, you want to add anything to this?
No, I think here if you look at the sideways market, तो हिंदी में जैसे हम कहते हैं market फंस गया है, it's not moving either upwards or downwards. It's stuck in a certain zone, a certain range. Asset allocation definitely it does deliver during that time much better than either of the asset classes singularly. So I think that is something here also it's visible that during those periods, the gap between the equity days to recover and the gap between the multi-asset to recover is narrower. While of course during fall periods it will protect, but I think its real significance comes when there is a sideways market.
Moving on, so multi-asset. I mean, before I delve into this slide, so if you look at how different is multi-asset from other hybrid products. So typically, other hybrid products has equity, which is a combination of cash and arbitrage and debt. So in the multi-asset, what is happening is that you remove some percentage of debt and you add commodity, as a component in that. So here, what analysis we are trying to do. So let's say if you add gold as a commodity in a multi-asset fund, so typically since you have removed debt and added gold, To that extent, over the historical period, gold has given slightly better returns than debt. But more importantly, I think if you look at the correlation between gold and equity, so it is minus 0.3, a good negative correlation. So I would say adding commodity or here gold in the anybody's portfolio, I think it's a good diversification which one can achieve from the portfolio building point of view. Now let's move on and let's look at our asset multi-asset allocation fund. How do we propose to strategize and run this fund? So to start with, so essentially, while we have essentially it will have key three asset classes with the option to invest in two more. So equity, given that the fund has equity taxation, the equity will be can be between 65 to 80%. Debt and commodity on the other hand. So we need to have at least 10% each in debt and commodity. So debt can be between 10 and 25%. Commodity again can be between 10 and 25%. While we have taken an option to invest in REITs and InvITs and as well as foreign equities. So those can be between 0 to 10 and 0 to 15. I will dwell further more into each asset class in terms of our strategy. Coming to equity framework, so this is a dynamic asset allocation fund. So to that extent, we can or we will vary the equity depending on the market conditions, market valuations. So what we have proposed here is the equity valuation will be between 40% and 75% depending on internal framework. Coming to equity as a portfolio, so again similar to the way we did other equity portfolios, it will be through the combination of top down and bottom up. On the equity portfolio, on the equity side, while it's a flexi cap, but given the investor profile, which we have in this fund, it will be large cap biased, equity portfolio. Coming to fund, so coming to the framework to build the net equity allocation. So we have a framework based on price to book and spread of a bond yield and earnings yield. Earnings yield is nothing but reverse of PE. Higher weightage is given to price to book, and so 75% weight is given to price to book and lesser to other parameters. So what we have done is we have taken last 10, 11 year daily data points and have done a simulation towards it. So there is a combined factor which comes out through the combination of these two parameters. So in case the combined factor moves up, which means the valuation moves higher, so we'll cut down the equity. And in case combined factor goes down, we will increase the equity percentage. So range, as I said, can be between 40 to 75. If you were to ask now what is the range, what is equity percentage could be. So model is suggesting, our internal model is suggesting that it could be around 55% or so. Over and above our internal framework, we also have taken some flexibility. Let's say if the 55% is what the framework is suggesting, so we can be at 53, we can be at 57. The flexibility is primarily, more technical. In let's say events like one fine day, if there is some action by Fed, or let's say a day like election results. So there, those events will not be captured in these numbers. So to that extent, we wanted some flexibility. So that's what we have taken. So this is again, if you look at the combination, so what we have tried to do, look at how this combination would look versus the typical indices like BSE 200 and Nifty 50. So on the right hand side, if you were to focus on the orange bar, so it is basically a 3-year performance. So standard deviation for our benchmark will be 30% or 33% lower than BSE 200 and Nifty 50. At the same time, if you look from the return potential, it will not be compromised. So moving on to framework to each asset class. So on the debt side, the investment it will be investment will be towards G6 and as well as AAA. While it will be buy and hold strategy, but it will be as active as one can do on the debt side. Right now, the modified duration on the debt side will be around 3.5 years. So 1 year back, if you look at our other hybrid strategies, we are at 2.5. Now, with the interest rate outlook, we have moved to 3.5 years of modified duration. On the commodities, again, we have an option to invest in gold, option to invest in silver, and we also have option to invest in exchange traded commodity derivatives, which we call it as ETCs. Essentially, I think we will, invest in gold and other two asset classes, other two, commodities will be tactical. Coming to REITs, InvITs, and foreign equity. So while there is lesser option right now in India in terms of REITs and InvITs, but what we will do is within that, given that this asset class is over and above the equity as asset class, so maybe to start with, we may invest, in one REIT. Foreign equity, on the other hand, will be a very tactical call. So if you were to ask me, if I want to invest in country like India, which is growing, let's say, upwards of 6%, or some other developed economy, which is growing, let's say, between 2 to 4%. So ideally, I would want to, invest in a country which is growing at a very high rate, which is India. But at the same time, there is also a possibility that, some other economy, the index of that other economy, at some point in time, may get really attractive. So our thought process is, in case, those index goes down below 1.5 standard deviation, so we might add that. So if you look at last 10, 11 years, whatever simulation we have did, so we could have added maybe 3 times, the foreign equity within the fund. Coming to equity framework, see, essentially, if you look at the returns of a multi-asset fund, it will be driven by 2 factors. One is how is the asset allocation between 3 asset classes, and then more importantly, how we go about building the equity portfolio. So in terms of our philosophy on the equity portfolio building is, so we focus on 3 things. One is business, how we select the business. Second is management quality, and third is valuation. On the business front, we try to focus on the companies which have a visibility of double-digit growth for at least next 5 to 7 years. In terms of profitability, what we focus on is ROC, so pre-tax ROC, return on capital employed, of at least 15%, post-tax 12%. On the management front, while it is subjective, but still, what we try to look at, in case the balance sheet of a company should be similar to the peers within the sector. Also, historical capital allocation decisions, capex decisions, have they been remunerative or value accretive for the company? In case mid cap, small cap, or IPO, so we obviously will do more due diligence in terms of trying to meet the promoter, as well as in case if there is a investment in terms of real estate or in PFC. So those are some red flags which we try to avoid. In terms of valuation, again, the focus is more on absolute valuation methodology, which is discounted cash flow, DCF. So as long as the value which you derive from the DCF is more than the price, which is generally known as margin of safety, as long as there is enough margin of safety, the stock can be part of a portfolio. Coming to equity investing, see, equity investing according to us is growth investing, but our philosophy is we will not buy growth at any price. So to that extent, our philosophy is growth up to a reasonable price, and that is reflected across our equity portfolios. On the portfolio front, while it's a diversified portfolio across the sectors, as such, by definition, it's a flexi-cap portfolio. But given the investor profile, which is coming to the hybrid funds, we will keep it large cap biased. So at any point in time, we will have at least 60 to 65% weightage towards the large cap. In terms of actual portfolio running, so see, core and tactical approach, that's how we do. What I mean by that is that core, so 80% of the time, the stocks may remain constant, on a 2 to 3 year basis, where the last 15% is what we do tactically. So many times stock prices move, let's say 5% without any fundamental reason, either on the upside or the downside. So there we do some weight changes. That's what I call my tactical approach. So coming to outlook for each asset class. So on the equity front, without dwelling much, so I think what our thought process is that India earnings growth for the next 2 to 3 years, the way we look at it and the consensus numbers. So there are multiple sectors which are driving the earnings growth. If you look at the macro front, India clearly stands out vis-a-vis many other countries in terms of GDP growth. Few parameters where India provides advantage in terms of government debt or in theme like deglobalization, where we do have we can benefit from this China plus one manufacturing opportunity already. If you look at, for example, Apple is talking to shift 25% of their production to India. So those kind of success stories through schemes like production linked incentives are happening. I think we are kind of prepared for the good growth over the coming decade or so. So to that extent, on the equity front, we continue to remain constructive on the equity as an asset class. On the debt outlook, again, as I said, a year back, our modified duration was 2.5. Now, with the interest rate outlook, with the recent Fed, whatever they have said. So to that extent, there is a possibility that as the inflation stabilizes over the next 12 to 18 months time period, interest rate should go down. So to that extent, we have increased our modified duration to 3.5 years. Coming to commodity again, while we know it can be as volatile as any asset class can be, again commodity prices not necessarily may or may not be driven by the underlying fundamentals, but at least the gold, which we know in the initial, which we are wanting to add in this fund. So gold as an asset class, historically, in case whenever the interest rates go down, so there is a negative correlation in the sense gold does well when interest rate typically goes down. So that's our current thought process on the gold. In terms of positioning, so while with this fund we will have 4 hybrid funds in our kitty. So at one extreme we have equity savings with 40% plus or minus 5% equity. At other extreme we have aggressive hybrid fund where equity is let's say 72% plus or minus 5%. In between those, we have this dynamic asset allocation fund. One is balance advantage, and second is multi-asset. Multi-asset is slightly ahead in terms of returns and risk, primarily because we are adding gold as a component, which while versus debt, it also has higher returns, but at the same time, it also has higher volatility. So who this fund is suitable for? So our take on this is as follows. So for the first time investors, who are coming to the equity markets for the first time, also somebody who is moving away from the fixed FD for the first time. So for them, typically what they look is they want lesser fluctuation. Investment journey has to be very smooth. To that extent, return expectations are also reasonable. I think for them, this clearly is the fund which we believe is a suitable fund. What this fund tries to deliver or aims to achieve, one, it gives diversification across 3 asset classes. It's a hassle-free way to invest into 3 asset classes, plus better experience in terms of risk-adjusted returns. Given that there is no equity in the portfolio, so there is a potential for alpha generation. Rebalancing, as I said, given it's driven by our internal framework. So to that extent, it really doesn't matter, what me as a fund manager or we think from the market valuations perspective. It will be a totally data-driven, kind of. So as the markets move up, so clearly in our internal framework will suggest equity percentage to reduce and vice versa. In terms of taxation, we believe it's given that it's equity taxation, so it's efficient way from the taxation point of view to invest into these asset classes. So for us as a mutual fund, there is no tax incidence in case we do buying or selling within the asset class. So overall, I think just to summarize, whatever I said throughout the slides, for the sake of repetition, but see investment experience, I think is much better in terms of it is smooth, so no extreme investment experience. So to that extent, I think as an investor, one might stick along with this multi-asset as a category because it's a combination of assets. So as Srini showed initially, kind of a quilt where at different years, different asset classes do well, but here we have a better relative downside protection. Internal framework is data driven, so to that extent, no human biases will come into picture. And on the three asset classes, as I said, equity will be between 40 to 75%. Right now, as I said, so 55% would be the equity. So given the equity taxation, so 65 minus 55, 10% will be arbitrage. On the debt front, while debt in the multi-asset funds or in the hybrid funds acts more as a stabilizer. So there again, we will invest more into G6 and AAA. On the commodity funds, our will be more gold tilted, fund. So in terms of fund management, so debt portion will be managed by Amit Mudani, commodity will be managed by Ritesh Patel, and foreign equities will be managed by Siddharth. So these are fund details for your reference. So NFO has opened today. It's up till 24th of Jan. Yeah. So I'll take a pause here, and maybe if anyone any questions, we can take those. Thank you.
Yes, let's move to questions now. I think one of the question which has come is if you could explain the standard deviation which we showcase for BSE 200 and benchmark. Uh, how do you equate that against the return? If you could explain that, that's one question from Mushrif which has come.
Sure. I think in the data, what we have shown that, if I recall correctly, so standard deviation on a 3-year, 3-year rolling return basis. So for the our combination, it was around 4.2%. If you look at standard deviation for BSE 200 and Nifty, so it was around 6.5%. So to that extent, roughly there was a 33% reduction in the standard deviation, or which is a measure of volatility. So 33% reduction in volatility. But on the return front, if you were to look at, while it underperformed, the BSE 200, but it has outperformed the Nifty 50. So I think what we are trying to say that to the extent that the key achievement is the big reduction in the standard deviation, but at the same time, returns are not compromised to that extent.
Right. I put the chart up in case one has to relook at it. I think one of the other way of reading this is look at the 1-year rolling return of BSE 200 versus the multi-asset benchmark versus the Nifty 50 benchmark. And then as you move to the 3-year and the 5-year, you see that the gap between the delivery of a broad-based 100% equity index against only a index which only has a 65% equity component starts sort of shrinking. And that's the beauty of an asset allocation product. As you move ahead in time, you will always have a much better risk adjusted return. While at the same point of time, standard deviation of the benchmark is much lower, yet it is competing with the equity indices. So I think this is the essence of this slide. Moving to the next question, which has come to us from Mr. Sagar, is if you could also throw a little bit light on the equity allocation of the product. What are you thinking right away once you've collected the money? What are going to be the initial sort of your position?
So, at a broader market, so while we didn't discuss too much on the equity markets front, but I think at a broader level, we do believe that, what has happened in the last 2 years. So, value has emerged on the large cap vis-a-vis, mid and small. That's one. But secondly, even from this fund point of view, from the deployment point of view, so one, given the investor profile itself, so as we said, we will be at least 60-65% large cap. So maybe on the day one, even we can start with 70% as a large cap allocation. In terms of allocation, I think while generally we don't take cash calls, we don't do double allocation. So to the extent possible, as early as possible in a 1 month's time period, or even less than that, given that it's a large cap based portfolio where liquidity is much better. So we'll try to invest at the earliest.
Sure. Mr. D. Kannan asked, what to expect in this product from a 5-year horizon. I think we already put out some back-tested sort of benchmark figures as to what it has delivered. But just for since Amphi also gives a guidance as to what the benchmark could deliver. So for assuming a 40% net equity, 40% net debt and 20% gold, the returns are for Nifty, GSEC and gold combination is about 9.92. Now, since we will have an equity tax product, the equity and the equity securities and arbitrage would cumulatively be more than 65%. I think we could expect a double-digit return from which the history is also proven. So, of course, past performance can never be taken into like a guiding light as to what can happen ahead, but at least it gives you a trend line. Okay, this is a question from Vishal. 1 year back, you launched the Balanced Advantage Fund. How is it different to this? Of course, gold gets added. Balanced Advantage Fund do not have gold. But in terms of your framework, could you explain what is the difference?
Sure. So again, both are driven by our internal framework in terms of what equity percentage should be. So I think Balanced Advantage experience for us has been, quite good in the last 1.5 years since we are launched. So we started the fund with 50% equity. We went all the way up to 58%. Now, as the markets moved up, over the last few months, now we are back to 50%. To that extent, I think this dynamic asset allocation has worked well. How different is multi-asset vis-a-vis Balanced Advantage? I think clearly, as Srini said, so there is the addition of gold, within the product. And when I showed the positioning, of all our 4 hybrid funds, so there, multi-asset was slightly ahead of Balanced Advantage, both in terms of return potential, but at the same time on the risk framework also. The reason primarily being, see, that we believe is more of a stabilizer factor in a portfolio. So eventual return generation is through equity portion. And then now in the multi-asset, which is gold, where, over the last 10, 11 years, the gold returns have matched or, been similar to equity as the asset class. So to that extent, I think the addition of gold gives a component of slightly better returns vis-a-vis on a Balanced Advantage. But at the same time, just to remind you again that the volatility of risk will also be slightly higher.
No, absolutely well said, because generally when you look at gold and in the Indian context, because of the rupee depreciation over a period of years, we have seen gold to be a very, very strong contender in terms of delivery of performance of an asset class, while nobody tracks it on a very daily basis to know that, what is the volatility of that asset class. It's actually much higher volatile than even a corporate debt sort of a framework. So I think well said that while you can look at this product, it will be slightly more in terms of risk element, it will be slightly ahead of the Balanced Advantage. Next question comes from Rohit, who wants to understand how will you decide the allocation between gold and silver? While you've been very clear in this presentation when you mentioned that we would begin with gold and play silver tactically, but what would be the trigger points for you to look at silver?
So see, silver historically we have seen, unlike gold, which has that the element of safe haven in case things go sideways on the globally on geopolitical front. Silver, on the other hand, it doesn't really have that kind of aura or storage value or safe haven element. The silver prices are generally primarily driven by industrial activity, given that large part of silver is also used in the industry. So to that extent, that's the reason we said it will be tactical approach unless it becomes really attractive in terms of to add silver. So the way to look attractiveness, the way I said in the international equities, in case it starts trading at minus 1.5 standard deviation, then is the time period I think we will try to add silver. Otherwise, I think we will be happy to invest through gold as asset class in the commodity.
All right. We don't have any further questions yet. Uh, Harshad, let's also discuss in terms of we have the other hybrid products, right? We have the equity savings product, which is a more static sort of an allocation. And then you have the balance advantage fund, which is dynamic an allocation. Even this product is going to be dynamic allocation, but it's going to add on gold to it as a feature. And then you have the aggressive hybrid category, which caters to unhedged positions, and it will go up to 72 to 77 sort of equity. Today, as we stand where markets stand, you know, looking ahead from a 2-year horizon, 3-year horizon, what's our sense as to if somebody has to come to an hybrid? Of course, we're talking about the hybrid multi-asset NFO, and we're discussing about the product, but as the market stand, where does one, should he sort of go to an aggressive hybrid and play there, or should he be a little bit more conservative to take this product and look at the next 3 years from that lens? And we are talking about investors who don't want the extreme volatility risk of equity. Neither he says that debt is good enough, so I want something better than that. So he's a debt upgrade investor, he's an equity downgrade investor. Now, uh, where does he stand? What between balance this and aggressive hybrid from a next 2-year horizon? What for us looks? What could be advice from us?
So I think, the positioning of both equity savings as well as aggressive hybrid, I think, is very much clear, in the sense somebody who is really risk averse, who just wants to participate in equity, but really shying away from that. So for him, equity savings is the right product, where equity, I mean, the percentage is 40%, lesser, much lesser percentage. Aggressive hybrid on the same time, I think, is a well positioned product, where people are okay with some equity volatility, because at any given point in time you are aware that the equity will be around 70% or so. So I think the positioning of these two products is quite simple, is very simple. I think the challenge comes in between balance advantage and multi assets. So how does one position, who is right and which fund is right at what point in time? So there, I think, not because we are in the NFO mode for multi-asset, but right now, in terms of the historical performance point of view, particularly I'm talking of gold as asset class. So as you know, what has happened on the interest rate front, right? Right from 2008 to 2020. So for a 12-year period, the whole world saw interest rates going down. So during global financial crisis, all the central banks took a stance that whatever it takes, we'll support the economy. It was almost a more than decade we saw interest rates going down. But once the inflation came back, and it came back, across the world, again central banks took a stance. Their key mandate is to curb the inflation or keep the inflation in check. So what took 12 years was reversed in 1.5, 2 years, right? And now, why from the gold point of view, historically what we have seen is that typically when the interest rate cycle is downwards, gold as an asset class, does well. That's a global phenomenon. So to that extent, I believe that right now, while I don't believe in timing, frankly, but to that extent, I believe, given this historical experience, I think adding multi-asset right now might make a lot of sense. So either you can go add gold on your own if you can do that. If not, then this is a fund which gives you an option to, and we have a decent allocation towards the gold at the day one. We might start with 13-14%, kind of a gold allocation. I hope the positioning is clear.
Yeah, I think that sort of gives a much better, clear picture for the investor to understand that today where does things stand across the world, across the economy, and why having gold in the portfolio would definitely make more sense from today's timelines. Couple of questions, different questions, but they are interlinked, so maybe I'll just join them together. Under what circumstances will you be highest or lowest in commodity segment? And would you ever be like completely zero on commodity? I think that is an easier answer, that in the category definition, you have to be minimum 10% all the times in equity, in debt, and in gold. So it will never be zero. But in terms of how do you decide what's going to happen, I think the previous answer what Harshad gave sort of gave a glimpse of what are the thought processes right now. That we may begin with 10 plus 2-3% sort of a gold exposure. But maybe the next question: when do you would see that okay, maybe we can be at 10 only and we cannot be, or maybe you play 5 gold, 5 silver, and cap it at 10, but you don't go up to 15. So what could that be?
So see, gold, as you know, while gold has done well in India, one of the reason is rupee depreciation to support the gold as asset class doing well. Just globally, as such, gold has been in a range bound in dollar terms. So to that extent, I think at least for the next 1.5 year, I presume that we may continue to remain overweight on the gold. Silver, in the meantime, if it becomes tactical, so we may add. Similar to our approach, in terms of when we add silver, when we add global equities, I think approach will be similar for the gold. In case it goes beyond plus, 2 standard deviation or plus 1.5 standard deviation, which is, beyond long-term averages, then we might start, cutting the gold. See, again, just to elaborate more on this, so commodity prices, be it gold, be it oil, or any other commodities. So given that one, these are global commodities. Secondly, the price performance or price movements rarely mimic the underlying fundamentals of those commodities. It really doesn't matter what is the production cost of gold. It really doesn't matter what is the production cost of oil. So as you know, oil in the Middle East can be produced at even at 8, 10, $12 also. But the reason why prices are where they are more to do with geopolitical and different other factors. So to that extent, commodity becomes more, I would say, dependent on the externalities. So that's the reason we are sticking to the fundamentals. We will stick to, because mean reversion we believe happens in all the asset classes. So to that extent, here also, in case gold goes beyond, let's say, 1.5 2 plus standard deviation, then we'll start to think of cutting that percentage.
Sure. There's a question from Adley who's saying since RBI has capped the overseas limits for investing, how would you manage that space? Adley, just before Harshit gives his view as to even if the space is available, whether we will deploy and what conditions we'll deploy. I think he briefly touched upon it during the presentation. But in terms of the space, now there are two parts to it. One is the overall 7 billion cap, which is on funds exposure. There is an additional $1 billion cap where if you can buy global ETFs. So that space is still open. So in case we decide to go abroad and invest, we could buy international ETF, which is a broad representation of the world market. So that is allowed, that is open. Right? But in terms of how do we see it today and when would we take it? Maybe Harshad, you can briefly touch upon, and we'll take one more question after this before we close.
Sure. Yeah, so as you said, the category which is closed, in investment in security is the $7 billion cap. So, anyways, we don't plan to invest in direct equities overseas. It will be through, ETF route. So, to that extent, that is still open. So, if you want to do now, we can do that. There is no restriction. But if you ask me, are you going to do it now? So, answer is clearly no. So, as I said, our thought process is when we did the simulation for the last 10, 11 years. So we could have, added, foreign equities 3 points in the last 10, 11 years. Again, for the sake of repetitions, our thought process is, if you give me two economies, one which is India and then other developed economy. So Indian economy, which is growing, upwards of 6 to 8%, and then there are other economies which are growing at a very low rate. So as a choice, I would want to invest in an economy like India, which is growing at a very fast pace. But at the same time, I don't want to lose on the opportunity in the developed markets in case they become really cheap. So that is what our thought process is. In case it goes less than minus 1.5 standard deviation, we may look at to add that.
All right. There are two questions, and One of that is on the debt portion of the product. How would you manage? Also, there is a question about um, how would you have looked at equity allocation in 2008 global crisis and 2020 COVID crisis? Of course, these funds did not exist during that time. Um, in our basket of products, 2008 was too early. I mean, we just launched our business in 2008 earlier. So, of course, we rode through the market. But how would you have looked at equity in COVID of 2020? If how did you do it in, say, the hybrid product? Maybe that's better way of looking at it, because multi-asset did not exist that year. And how are you going to look at the debt portions? Maybe these two, and then we will close this session.
Sure. So on the equity allocation at that, I mean, historically what it could have been. So in our internal simulation, we did see that the equity percentage would have hit. So for example, in this fund, it could have hit 75% in both the occasions. Even for that matter, if you have to look at history of aggressive hybrid fund, which was existing, during the COVID crisis, so there too also, we went to the highest level possible in terms of, equity percentage. So to that extent, I think our own internal framework, I believe, works beautifully in terms of, responding to the market movement. So that is very much clear. On the debt front, while it will be managed by my colleague, the debt fund manager Amit, but I think the way we have been doing it in the other hybrid products, so see they are they are as active as they can be in terms of the management of the portfolios. Typically, as I said, G6 and AAA, what they invest into. On the modified duration, also they are as active as they can be. So as I said, a year back they were at 2.5. Now with the interest rate outlook, they are at 3.5 years. Srini, if you want to add anything on the debt front, I think beyond what I've said.
No, absolutely. I think I'll probably, before we end, just mention one thing that, while we ourselves visit the ATM, there is only one requirement, which is cash, right? And when we do not have that there is a bit of disappointment which sets in. So as a fund managers, when you build portfolios, I think the first criteria, whether it's an equity portfolio or whether it's a debt portfolio or a combination like this, is the liquidity of the portfolio. So you would first give preference to stocks, or even on the debt side, if you're holding bonds, that whether they are traded in the market, whether the market is liquid itself, and whether when you want to exit, whether you can honor those commitments or not. I think that plays a very important role. So liquidity management plays a very important role. And for this sort of products, debt options have to be liquid, because equity is the deciding factor in terms of how much percentage will be moved up and down. So the debt should do the defensive part of managing the liquidity of the portion and giving the stability. So it will be very difficult for somebody to have longer durations here and then try to sort of manage the entire liquidity of the portfolio. So one thing is for sure, that we are very comfortable with liquid names, both in the equity side as well as on the debt side. It's about quality. So that's the framework across our hybrid products, and we do not see anything to be different here. That's what I will sum up. All right, so I guess we have run out of questions, and we're also about time to wrap up. I would really thank our audience to have joined this live session and participated and asked a lot of questions. I hope you've got the gist of what the mid-asset multi-asset allocation fund is all about. The fund is open from today for subscription, and it will close on 24th of January. You can connect with us across our various digital assets, our website, our WhatsApp chatbot, or even the mobile app that we've launched now. You can come to there, you can understand about the product, and then make a wise decision. Of course, do connect with your advisors, your mutual fund distributors, to know how does this product fits into your portfolio. So Thank you, everyone. And thank you, Harshit, for taking time and explaining the product to our investors. Thank you. Bye-bye.
Thank you. Take care. Bye.